So big tech is making the same kind of bet that blows up entire decades. And right now, the biggest tech companies on earth are borrowing and spending like the future is guaranteed, while the buyer's side of the market is still stuck in AI pilots that haven't materialized. So today, I want to walk you through big tech's AI gamble and why, if this cycle cracks, everyday investors and taxpayers are the ones who are going to pay the bill. So here's the core idea. Big tech is building AI infrastructure at an industrial scale. GPU clusters, data centers, power contracts, all assuming demand will eventually catch up. But if demand grows slower than the build out, or if prices collapse, or if utilization disappoints, then this turns into a very familiar story. Overcapacity, debt, and a quiet transfer of cost to everyone else. In January of this year, Reuters reported that the biggest AI hyperscalers, Amazon, Google, Microsoft, Oracle, issued $121 billion in bonds in 2025. Way above their typical pace earlier in the decade. And analysts expect AI buildouts to push UX corporate bond issuance even higher in 2026. So this is a key signal. When a tech boom shifts from we're funding it with cash to we're funding it with debt, the stakes change. And the scale is not subtle. Goldman Sachs published a piece in December of last year saying that AI hyperscaler Capex could exceed $500 billion in 2026. That's $500 billion in 1 year, just to build the pipes. Now, to be fair, these companies generate a lot of cash. They can afford big bets. But here's the thing. Even if they can afford it, they still have to justify it. Because data centers are not like software experiments. You can't pivot a half-built campus and multi-year power contracts. Once you pour the concrete, the question becomes, who's paying to fill it? And this is where the hype narrative starts to break. Because AI everywhere is not the same thing as AI is paying for itself at scale. McKinsey's 2025 global survey basically says the quiet part out loud. Nearly 2/3 of organizations have not begun scaling AI across the enterprise, which means there's lots of demos, lots of pilots, and not a lot of we built our core processes and now we're burning serious compute every day. And Gartner has been even blunter. It predicted 30% of generative AI projects would be abandoned after proof of concept by the end of the year, because of data quality, risk controls, escalating costs, or unclear business value. That's the pilot plateau. The story isn't nobody uses AI. The story is almost everyone is testing AI, and a minority can scale it into real operations. And that gap matters because the build-out assumes the opposite. It assumes a world where AI becomes like electricity, always on, everywhere, and embedded into everything. But enterprise adoption doesn't move at hype speed, it moves at governance speed. Procurement, compliance, and I don't want to get fired if this leaks our data speed. Now here's the second thing that people miss. Even where demand exists, pricing is getting crushed. Stanford's AI index shows that the cost to query a model at roughly GPT 3.5 level dropped from $20 per million tokens in November of 2022 to 7 cents per million tokens in October of 2024. That sounds really great for adoption, but for the companies building $1 trillion worth of infrastructure, that's a nightmare scenario. Because if compute turns into a commodity, then you get a world where usage rises but profits don't. And suddenly that $500 billion build looks less like an investment and more like overcapacity. Now you might be thinking, okay, but big tech is already making money from AI. Sure. Microsoft even said AI business surpassed an annual revenue run rate of $13 billion. But notice the mismatch. $13 billion is meaningful, but it's not $500 billion of annual capex meaningful. And that's the key point. The revenue is real, but it's not clean, and it's not obviously proportional to the spending. A lot of AI is bundled inside cloud contracts, seat licenses, ad tools, things that make it harder to answer the underwriting question. Is this incremental, durable demand? Or just features getting stuffed into the bill? Which brings us to the debt gamble part, because the build-out is being financed in ways that connect it to the broader system. In January of this year, the Bank for International Settlements put out a bulletin warning that the size of anticipated AI investments will push financing from operating cash flows towards debt, with private credit playing a rapidly increasing role. Private credit lending to AI-related companies has grown to over $200 billion, and the share of private loans to AI-related firms rose to almost 8% from less than 1%. That's how a tech capex story becomes a macroeconomic story. Because now it's not just big tech shareholders taking the risks, it's bondholders, credit funds, pension-chasing yields, and insurance portfolios. And when debt gets involved at scale, The unwind is never clean. The BIS also makes a brutal point about expectations. They say sustainability hinges on AI firms meeting high earning expectations, and that if expectations aren't met, you can see sharp corrections in both equity and debt markets. So the risk is we built too much, too fast, financed it too aggressively, and returns didn't show up on schedule. That's the bubble structure. Now let's talk about who fronts the bill when the bubble bursts. Because even if you've never bought a tech stock in your life, this boom is already pulling cost into your world through 3 channels: tax incentives, utility bills, and systemic concentration. So first, subsidies. A 2025 Good Jobs First report found at least 36 states have subsidies crafted specifically for data centers, but only 11 disclose which companies receive them. And the report's takeaway is basically, this stuff is happening in the dark. There's no clear numbers, no clean job reporting, and no easy way for taxpayers to see what they're actually buying. In Virginia, arguably the data center capital, governing reports that the state lost $1 billion in revenue through the data center sales tax exemption in fiscal 2024. That's real revenue that could have funded schools, roads, or tax relief. Instead, it's please build your server farms here. Second is electricity. The US Department of Energy says data centers consumed about 4.5% of US electricity in 2023, and it could reach about 6.7 to 12% by 2028. Globally, the International Energy Agency projects data center electricity consumptions could double by 2030, and AI is the biggest driver. And as demand hits the grid, somebody pays for the upgrades. The Washington Post reported that US residential electricity prices rose about 40% from February of 2020 to July of 2025, while commercial rates rose much less. So this is the structure of the transfer. Households eat rising grid costs while mega users negotiate special treatment. Reuters reported that the US Energy Information Administration expects US power consumption to hit new records in 2026 and next year, with data centers as a key driver. So even if the AI boom works, your bill can still rise because the grid has to expand and harden. But here's the darker version of the story. What happens if the demand doesn't show up like the builders promised? Then you get stranded assets. And stranded assets are where the public gets trapped. Earthjustice asked Louisiana regulators to investigate Meta's $27 billion data center project financing, arguing that the structure could leave utility customers on the hook for billions in power plant and transmission costs if Meta exits early. So, hear that again. So if the tenant can walk, but the power plants can't, who pays? It's not the shareholders. It's not the executives who got the bonus for building the future. It's power customers, like you. Thirdly, market concentration. Even if you don't pick stocks, you probably own the index through a 401k. The Federal Reserve's November 2025 Financial Stability Report said that market contracts flagged the risk of a sharp decline in asset prices potentially connected to a turn in AI sentiment as a salient financial stability concern. So that's the Fed basically saying, if the AI story turns, this could matter for the whole system, which means the AI trade isn't a sector bet anymore. It's a benchmark bet. It's a wealth effect bet. It's a political pressure bet. And that's how you get the soft version of too big to fail. Not because the government writes a check that says bailout for GPUs, but because if the unwind hits household wealth, credit markets, and local tax bases all at once, policy starts leaning towards stabilize the situation. And the cost gets socialized quietly. So what does the pop actually look like? It's not one dramatic day where everything goes to zero. It's slower, uglier, and more familiar. First, utilization starts to disappoint. Then pricing gets more competitive. Margins compress. Capex stays high because projects are still not finished. Free cash flow gets squeezed. More financing will start to fill the gap, and credit spread widens. Analysts start asking uncomfortable questions like, why are we building a new data center if the last one isn't full? Then eventually the narrative starts to break down. Maybe it's a quarter where enterprise spend doesn't accelerate. Maybe it's a big write-down. Maybe it's a wave of canceled projects. Or maybe it's just the simple fact that AI becomes good enough and cheap enough that customers refuse to pay premium pricing. And when the story breaks, the exit door is small because the trade is crowded. The weights are massive, and the debt is already wired into portfolios that were never built for a boom bust in compute real estate. Now, so here's an important note. This is not an anti-AI video. AI is very useful. In some domains, it's transformational, but that's exactly why it's dangerous. Because real technology can still produce a financial bubble when money outruns cash flow. The internet was real, mobile was real, railroads were real, and all of them produced cycles where infrastructure got built ahead of demand and investors got wiped when expectations didn't land on schedule. So what should you take from this? Two things. One for investors and one for citizens. If you're an investor, stop confusing amazing tech with amazing risk-adjusted returns. Because if the answer is price war plus overbuild, then the winners are not guaranteed to be the biggest spenders. If you're a citizen and a taxpayer, demand transparency. Because right now the public is already in the deal. Through tax breaks, through grid upgrades, through electricity bills, through retirement index concentration. And if society is being asked to underwrite the risk, directly or indirectly, then society should not be the last in line for the benefits. That means no subsidies without disclosure, no sweetheart utility contracts without public review, no trust us, it'll be worth it energy buildouts where households carry the downside. And no pretending this is purely private risk when the spillovers are already showing up in financial stability reports. So the bottom line is simple. Big tech is borrowing huge sums of money to build AI infrastructure at warp speed, betting that demand will eventually catch up. And maybe it does. But if it doesn't, if enterprise scaling stays slow, if pricing collapses, if utilization starts to disappoint, then the unwind won't stay inside Silicon Valley. It hits bond markets, it hits retirement accounts, it hits state budgets, it hits your power bill. That's the AI debt gamble. And unless we get serious about who carries the downside, you'll pay the price.